Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, July 2nd, and you're tuned in to On Trend. So we're going to start with market condition because it matters, and we'll see why it matters now. We're going to dive into cannabis stocks and cybersecurity stocks. Oil and XLE are hitting potential reversal zones, and retail stocks are still suffering. Now, I think it's important that we understand the general position of the stock market. And by that, I mean SPY, because that represents the benchmark as far as I'm concerned for the stock market, the S&P 500. And, the bulk of the evidence has been bullish since the middle of February, according to my model, and it remains bullish. So, the trend is clearly up, and we still want to favor long positions over short positions. That doesn't mean there aren't pockets of weakness out there and we can't get corrections. And that's why I think it's important that we understand the market position. And right now we've moved back to a short-term overbought condition. Now, overbought in an uptrend is really just neutral. All right, it's not a bearish indication because especially in uptrends, you can become overbought and you can continue to move higher and stay overbought. And there's two ways that the market can work off an overbought condition: in time by, say, moving sideways, or in price by correcting. But when you're overbought, the chances of having some sort of a corrective period are increased, shall I say. So when we look at the chart now here for SPY, we had a oversold condition there in the latter part of May. And we got that reversal and that breakout. So at that point, the breakout was pretty fresh. And we got above the 50-day and we started getting overbought. And we stalled for about 5 days. And then we got another push higher and we got overbought. And then we had a pullback. And that alleviated the overbought conditions. We held above the 50-day and we got another surge to become overbought again. Now, again, overbought is more neutral than anything, all right? It's not a bearish indication. And I'll go ahead and leave my first support level there at 288 based on the lows from the middle of June and that 50-day. And we're in a strong uptrend as long as we hold above 288. We break below 288. Okay, maybe we're in a short-term downtrend, but we're not long-term bearish by any means. And I'd have to look at the indicator table that I use before I would make any kind of assessment on the longer-term trend. Now, when we look at the QQQ, we can see that it's in a similar condition. It had this big move up, had the breakout, a little bit of a stall, and then another surge. And then look, we had this huge decline based on, I don't know what. I mean, yeah, I'm sure we can go find a reason after the fact. But then we firmed immediately and we had a big old surge based on, I don't know what. And of course, I'm being pretty sarcastic here because the market is moving to and fro based on the latest on the tariffs. But I think you got to put all that stuff out of your analysis picture. All right, I'm not saying it doesn't matter, but what I'm saying is we can't be trading off of the news. We have to be trading based on the charts. All right, so, we're overbought with this big move, and then we stalled, and we got a breakout, and we were overbought, and then we got a pullback, and we alleviated those overbought conditions, and now we've got a surge. And this is bullish, no doubt about it. And as long as the S&P 500 remains above its 50-day, I would expect the NASDAQ 100 also to move higher. Now, small caps caught a bid on Thursday and Friday last week with a big move. As you can see here, we got that big 2-day surge. Strong open yesterday, but a weak close. I'm not going to start getting into the candlesticks here, but what I pointed out last week was we had basically 5 black candlesticks and 4 days down in a row. And things are looking very bearish after such a decline. But it gave way to a huge bounce. And if you just look back at recent history, you can see there are 4 black candles and a sharp decline that gave way to a bounce. There is a 4-day decline. And look at that big decline that led to a low and a bounce. All right, so keep that longer term picture into perspective. Keep the S&P 500 in perspective, all right? The S&P 500 is the main driver here. They're the dog, okay? The S&P 500 is the dog. Small caps are the tail, all right? And the tail does not wag the dog. It's the dog that we need to be watching. As long as the S&P 500 is in bull mode, I expect small caps to at least hold up, all right? They might not outperform, but I expect them to at least hold up. So I want to look at some cannabis stocks because some of them are setting up, and as we'll see, all cannabis stocks are not created equal. If you're looking for a list of cannabis stocks, you can go to the Alternative Harvest ETF website. It is etfmj.com, and the cannabis ETF is appropriately symboled MJ. And if you scroll down on that website, you can see the top 10 holdings, and you can also download a list of the holdings if you want to follow some cannabis-related stocks. So the reason cannabis stocks caught my eye is because the Alternative Harvest ETF, MJ, is trading in a reversal alert zone, and it is firming. So what is this reversal alert zone? Well, basically you have what looks like an impulse move. And this is the move from 23 to 38. That is a huge move. You're entitled to a correction after that move. And so this decline here looks like it could be corrective. And why do I say that? Well, you can see there's the 50 to 62% retracement zone in that, say, 29 to 31 area. And that's where it moved into. And it bounced off that zone and started to firm. So this is basically 2 steps forward and 1 step backward, and that's kind of how you get a zigzag higher. Now, admittedly, the cannabis ETF has done nothing the entire year. It's been above and below that 31 level the whole year. It's been above and below its 200 days, so the 200-day hasn't helped either. But what I'm seeing is, as far as this reversal alert zone is in addition to that retracement zone, you have a broken resistance zone turning into support from that January consolidation, and you came back to that zone there. So we have an argument for support. We have an argument for 2 steps forward and 1 step backward. And now we're looking for something to suggest we're continuing that impulse move, which was the move from late December to March. And so that surge in June, early June, is the first sign. Got a little bit of a pullback. And if we can get a follow-through breakout there above that June high, that's going to be bullish. And I just added RSI to this chart as well. And the green vertical lines show when RSI became oversold. And it's done that 4 times when it moved below 30. And you got some pretty good bounces, not exactly at the bottom in July, but at the bottom in August and near the bottom in December. And this could be an interesting low here in June. Now, these stocks and this ETF are not for the faint at heart, all right? You probably need to account for a little bit of above average risk when you're dealing with these cannabis issues. And some, companies aren't going to make it. Some are going to make it. It's a very relatively new industry. And looking at some of the stocks, here's Aurora Cannabis, and it's got a similar profile as the MJ ETF I showed you, in that you have the big surge and then you have this pullback and it's retraced around 50%. There you have support in that 6.5, 7 area. We've got a couple of bounces here to affirm support and looking for a breakout there. Then we look at Alphria, and you can see it's a low price stock. So it's going to have high risk, high reward, but high risk. Keep that in mind. It's got a similar profile in that you had this big advance, and now we've got a correction retracing 62%. We're firming, and if we can get a breakout there, that is going to be a bullish development. Canopy Growth. Now, here's what happens. I was watching this stock in April and saw the breakout, and it looked like a bullish breakout, but it didn't hold. All right. And another thing, if you notice, we started declining, and we had 1, 2, 3, 4 days down. And look at that decline on the fourth day. It looks the ugliest, but it gave way to a bounce. But it's trying to firm here in that 40 area, and watch for a breakout at 44 to get canopy growth back on the bullish track. Cronos probably looks the strongest, other than the next one I'm going to show. But what you can see here is that Cronos had a big surge to a new high. So October to January, that's a new high. And then it pulled back with a wedge, came back to broken resistance, which turns into support. And then you had that 61.8% retracement zone where it firmed. You got the gap up and then the breakout of the wedge. And we're holding above that breakout zone. So this one looks interesting. Risk to reward is not bad too. I mean, if you're nervous, you could get out on a move below 15. But right now it looks like the breakout is holding and it looks bullish. And then GW Pharmaceuticals. This is the only one that's probably a pharmaceutical healthcare stock. The other ones, I don't know if they go in staples or consumer discretionary. But GW Pharmaceuticals has the most bullish chart of all for the simple reason, or the relative strength you can see, because it hit a new high there in early May. And it's got this mild wedge correction working here. So watch for a breakout there at 180 to continue higher. And then the last one is Tilray. And, I'm not even watching Tilray. Well, yeah, you could watch it, but it is a pretty volatile stock here. And, it's been declining, but looks like it's trying to break above that trend line. And you got a little higher high working there and maybe a little wedge. So this one's a very volatile one, but it looks like it could be poised to make a move. But I would probably just stay away from this one. It's just too volatile for my blood personally. Now, I followed the cybersecurity stocks for a while, but you can see it's a real mixed bag when you look at these individual charts here. And if you want to know which stocks might be involved in cybersecurity, you can go and look at the Hack ETF. It's on the ETFMG.com website. There you can see that's the Fund Family ETF MG. And I'm on that website, and you can go down and you can see the top holdings there for this ETF. And the other one would, of course, be the First Trust Cybersecurity ETF Cyber. And there you can see the top holdings there. Now, I don't know what Raytheon is doing in there, but it accounts for 5.64% of the ETF. BAE Systems is also in there. So, I wouldn't put those two in there necessarily. But you can see Okta, which is one of the newer ones, and Zscaler, another one of the newer, better performing cybersecurity stocks. Now, before I go into these stocks, I ran across this article, and this is from the University of Michigan. And if you want to find this article, you can just Google new chip stops hacks before they start, Michigan. And you'll get this article. But what really caught my eye was the opening paragraph, which is what it's meant to do. It's meant to get your attention. But it's talking about a new computer processor architecture that could usher in a future where computers are proactively defended against threats, rendering the current electronic security model of bugs and patches obsolete. All right, and what does it do? Well, what it does is it encrypts and randomly reshuffles key bits of its own data 20 times per second. And so even if a hacker is there working on doing the hack, that data is being reshuffled 20 times per second. And by the hacker figures it out, it's been reshuffled and the hacker has to start again. So it's a very interesting concept, and it just shows you how fragile some of these companies might be to some new developments. And so that's why you got to be very careful with individual stocks here. So I went ahead and put these into a chart list, and there you can see I put cyber up at the top, and there are the top 9 stocks, and I chose 9 because I can get 10 charts on one page. And also you can do a little bit of finagling with the data, view list as, and I can choose summary format, and then I can see how these are performing over a certain period of time. So we're at intraday, but if I go to 3-month, look at that performance over the last 3 months. Okta is the only one that is really leading and outperforming. VeriSign's up 13.5%. Zscaler's also doing well, but look at all the other ones. All right, they're either flat or down. F5 and Palo Alto are down. And let's go to year to date. And if we look at year-to-date performance, we can see it's better, but there are the clear leaders, Zscaler, Okta, and VeriSign. So I want to look at some of these charts. I have a second chart list, and it includes the top stocks that are in the Hack ETF. And there you can see year-to-date performance. Proofpoint, Tenable Holdings, and Cisco are leading the way. But if I go to 3 months, you can see a different picture emerges. All right, Carbonite is leading. Cisco is pretty much flat. Proofpoint is flat. And the rest of them are down over the last 3 months. So it's a very vulnerable sector. But let's look at some of the individual charts that stand out. So also when you create a chart list, you can view the charts in that list in candle glance format, and that gives you up to 30 charts per page. Here I'm looking at the top 9 stocks for Hack, the cybersecurity ETF. And if you look at this, one of them stands out as the strongest, and that is clearly Cisco, because you can see Cisco hit a new high here in June. It's kind of got this consolidation here, and it broke out but fell back into the consolidation. But I would still have it on my radar for a bullish setup. You know, maybe if it pulls back even to that 50 area, that could be a potential buy zone or lower risk entry point. Looking at some of the other ones, it's kind of a mixed bag. The red line is the 200-day moving average. And you can see there's Symantec, and it's just moving back and forth, going nowhere, getting these big surges off support and big plunges after making higher highs. Proofpoint might be positive here because it's got a little breakout. So first it surged and broke out, had a pretty sharp pullback, but now it's turning back up here. That's one worth considering. But I want to look at the next list because there's 3 that really stand out and look more like the Cisco chart in that they're in a bigger uptrend. So if you're just looking at these charts, which 3, and I'm not including Cisco, stand out? Which show the most consistent and persistent uptrends? And it's really not hard to figure out which 3 I am talking about. I mean, you just do a little elimination here. F5, no, it's in a downtrend. Juniper, it's in a downtrend. We can see Splunk got hit really hard, but it's bouncing. So perhaps it's ready to continue higher, but it's still more choppy. Palo Alto is below its 200-day. Symantec is just all over the place. And then we look at Okta, and what a move. You know, it more than doubled from 50 to 130. So maybe it's overbought, but it is one of these stronger ones and one we want to look at on potential pullbacks. The same with Zscaler. It was consolidating here and then got the big breakout and move higher. So if it pulls back, it's also one to consider. And then VeriSign, look at that big move up above 200. So watch for it on pullbacks. Keep that one on your radar. But again, with this group, you really got to be picky and look for the strongest and wait for the stock to come to you. Get your bullish setup. So I became frustrated with basic chart analysis using the sector SPDRs, you know, looking for support and resistance and patterns and breakdowns and moving averages. And instead of just using the price charts, I use an array of breadth indicators to derive my bullish and bearish signals for the 11 sector SPDRs and for the broader market indexes, the S&P 500, S&P Mid-Cap 400, and S&P Small-Cap 600. And the breadth tables, of course, are updated every Friday in the State of the Market report, where I tell you how I stand on the market with some nice tables there to illustrate. But energy of the 11 sectors is the only sector that is on a bearish signal. All other 10 sectors are on bullish signals as far as these three breadth indicators are concerned. So what are these breadth indicators? Well, the first one is the 10-day EMA of 80%, and that's for a bullish or a bearish breadth thrust. And these indicators turn net bearish again in May when all three were on active bearish signals. You can see the 10-day EMA of 80% moved below minus 30% to trigger. The high-low percent indicator was already on a bearish signal when it initially moved below minus 10% in October, and the percentage above the 200-day moved below 40% in early May to trigger bearish. So when you added all three signals up in early May, all three were net bearish. So one of them triggered bullish in June. That's the 10-day EMA of 80%. So we got a bullish breadth thrust, but you need one of the other two to confirm, and we did not get that. All right, you can see that high-low percent didn't move above plus 10%, and the percentage of stocks above the 200-day EMA did not move above 60%. So this sector is still bearish. It's still the weakest sector, and I'm totally avoiding energy stocks just because of the sector performance. And then when I dive down a little bit further, I see a bearish setup on the chart for XLE and for oil. And if you look at XLE, I talked about a reversal alert zone where you can get a bullish reversal alert zone like I showed you on the MJ, the Alternative Harvest ETF, and you can get a bearish reversal alert zone too. It's the opposite, of course. But basically, it's got the same things. First, you have an impulse move to the downside. Then you have a bounce that looks like it is a corrective bounce after that big decline. So basically you have two steps down and then you have one step back up. And you can see you came into that 50 to 61.8% retracement zone with this bounce. Actually, you hit the 61.8% retracement. You had resistance from these two highs coming into play. And then we had the breakdown there in April, May. So what do we have now? Well, we have a smaller version of this bearish reversal alert zone in that you can see we've had a sharp move lower. We've had a bounce that looks like it's a corrective bounce after that big decline. And we're coming into a resistance area from these previous highs in May there. We also have a 61.8% retracement. So I would be on guard for a potential breakdown in XLE here. And you can see the PPO is just positive. This is the PPO 535.5. So it turns negative when the 5-day EMA moves below the 30-day EMA. So if that one turns down, that would be a confirming signal to watch for XLE. I'm not even going to show the XES chart because it's one of the uglier charts. Sure, it's had a bounce in June, but overall, it's still one of the weakest charts out there. And then we look at oil. You know, oil has a bearish setup too in that it's moved up to a bearish reversal alert zone. So basically what we have is there's the bigger one. You had the big decline, and then you had this bounce. And it moved over the 61.8% retracement, which it sometimes does. I mean, keep in mind, we're not using the Fibonacci numbers per se. I'm looking for anywhere from 1/3 to 2/3. Charles Dow advocated a 1/3 to 2/3 counter trend bounce. And so this is, getting up to 2/3. And then we hit this broken support level turned into resistance. So that confirmed the potential reversal alert zone, and then we had the breakdowns. So now we have this big sharp decline in oil from 66 to 50, and we have a bounce, and the bounce is now in a reversal alert zone. So this is the impulse move lower. This is the corrective bounce that retraces around half. As you can see, it's retraced between 50 and 61.8% of that prior decline. You can see broken support turning into resistance, and we're stalling. So watch out. If oil breaks below that low from last Friday, then that's going to be a short-term bearish reversal. So I would be careful on oil and oil stocks. There will not be a live show on Thursday, July 4th. I'll be back again on Tuesday, so have a happy 4th. So now I want to touch on retail, because the retail group, sure, there are some bright spots, some strong spots, but there are also some weak spots. And overall, I think retail is weak. Is that the death knell for the bull market? No, I don't think so. I think there's more to it than that. We need to look at technology and some of the leading sectors to see if they break down. But looking at retail here, you can see that, it had the breakdown there in April, May, and then this bounce here has come to a reversal alert zone. All right, first you have broken supports turning into resistance, the red zone. This bounce here has retraced 50 to 61.8% of the prior decline. So that's like 2 steps down and 1 step back. And it's formed a bearish wedge. And if we break that wedge, that would signal a continuation lower. And if you look at this RSI indicator, you can see it has not been above 70 since last summer. So all these bounces failed to get RSI above 70. So retail just doesn't have any bullish momentum. Then if we look at Dillard's here, Dillard's looks pretty dull here. We had the big decline with the rest of the retail in April and May, and that looks like a bear flag taking shape. And if we break flag support, that's going to be bearish. Then we look at Macy's. There's a strong downtrend for Macy's and a 52-week low. And we got this bounce here, but you can see broken resistance turning into first, or broken support turning into first resistance. And then we look at Polo Ralph Lauren. It's hitting into a bearish reversal zone. You can see first you have broken support turning into resistance. You're in the 50 to 62% retracement zone. You've had a big move down. You've had a counter move. And if you break that support level, that's going to signal a continuation lower. And finally, Tiffany, similar situation, a breakdown, a bearish wedge, and if you break support there, that's going to signal a continuation lower. All right, so that concludes this edition of On Trend. There will be no show on Thursday. I'll see you back on Tuesday. Have a great 4th of July and a great long weekend if you're taking it. Take care.